Bloomberg. Rates unchanged at 0.1%. The asset purchase target unchanged at 745 billion sterling. A little bit of new guidance here, though. The Bank of England won't tighten until significant progress on its inflation goal. To break all of this down, Bloomberg's Guy Johnson joins us now. Good morning to you, Guy.
Good morning. That actually made me smile because the story here in the UK is not about raising rates, John. It's still about cutting rates. The market is expecting that we'll see additional QE in November, and there is a growing expectation that we will see rates being cut, possibly into negative territory. We're at 0.1, remember now, John, and we could see a significant move below that. Bank of America is saying that we could see rates negative 50 basis points in the event of a hard Brexit. The Sonia curve over the last few weeks, Tom, John, Lisa, has been starting to price in the increasing likelihood of a cut. Tom?
Yeah, you nailed it, Guy. I mean, significant progress, and I smiled, too. John Farrell, this is the heart of the matter and links what Guy Johnson's looking at with what Michael McKee was looking at yesterday. There is a verbal melange almost of the vector to higher inflation. Do we change policy as the vector shifts? That's a Bundesbank. Do we change policy as the vector moves up? Significant progress. Or do we wait like Kashkari to actually see the inflation ex post to act? Did I say that okay?
Well, Tom, I think you did pretty well. I started this conversation with the one similarity between the Bank of England and the Federal Reserve. It came down to fiscal policy. Guy went straight to the key difference, and that's the story right now. The headline dropping across the Bloomberg as follows. The Bank of England discussed the effectiveness of negative rates. They were briefed on how to implement negative rates effectively. Guy, over the last couple of months, the Governor, Andrew Bailey, has flirted with negative interest rates. I would say they're actively preparing to execute negative interest rates, going on this commentary right now.
The language certainly has been heating up, hasn't it, John? As the governor has left this very much in the toolbox. There are still many that think that the UK economy is not suited to negative rates in the way that it is structured with the mortgage market and other factors as well. But tools in the box starting to look a little bit more sparse, John. QE almost looks nailed on as a certainty at this point. That's simply down to the economic trajectory that we find ourselves with. The unemployment story at the moment in the UK getting worse and worse. The furlough scheme soon to end. It may be extended in some shape or form, but the effects of rising unemployment are going to be felt. And then you factor in the no-deal Brexit, and that has been the change in the thinking, it seems, of late. That is, it seems, the policy response to a no-deal Brexit would be to cut rates and cut rates aggressively into negative territory. And as you say, it does seem as if the bank is warming up, getting ready. It looks more and more of a likelihood than it certainly did even a couple of weeks ago.